what is today? Is it just an oversold bounce, or is there some real hope?
I think it's an oversold bounce. I mean, the market's a kerfuffle right now. I mean, on a near-term basis, it's literally impossible to be managing money over the next few months, and that's why we had a terrible month in May, just because we run portfolios for BMO that are more concentrated, 35 to 40 stocks, and we have big positions in financial, so obviously we had a terrible month in May. But I don't manage money, nor do I manage a strategy product for both the United States and Canada with respect to a month-long basis. We still think we're in a bull market. We still know that the market's up 9.5% year to date. We still know that earnings came in way better than everybody thought. And in fact, on March 31st, Sarah, earnings for the first quarter were supposed to be down 4.4%. We have 7 companies left in the S&P 500. Now we're only down 0.2%.
You're citing backward stuff, though. Earnings that has already come in, the market that's already up for the year.
How is that any different, though, than people talking about tariffs, where you don't know exactly 3 months down the line what's going to be? We continue to focus on factory orders and macro stuff.
Earnings expectations, though?
Earnings expectations actually have begun to settle in and actually improve for second and third quarter bottom line. So I think this whole notion with respect to an earnings recession and earnings are going away is completely bunk. It's not correct. And people are still fearful. All we have to fear is fear itself, and we are running this market in terms of equities on fear and not fundamentals.
Well, we have fear to fear, and then we have actual headwinds on trade and negative earnings to worry about too.
We do, Carl, but here's the deal. If you're trying to manage a portfolio based on a tweet over the weekend, in which within the next 24 to 48 hours, all of this Mexico stuff could be gone,
right?
You are doing yourself a great disservice, and more importantly, you're doing your clients a disservice. Now, with respect to the tariffs, we know this has been going on for a while. I call this a tariff tantrum, just like we had in December. And from a timing perspective, you think about the timing on all this is happening. It's kind of funny how it's happening during the slowest market period. So once we get this tariff situation resolved, slowest market period in terms of calendar performance, May to August is always the worst, September. And so we think that we're going to have a bang-up performance in the market later in the year.
Druckenmiller last night said he's piling into treasuries because he doesn't want to play in the exact environment you're describing.
Yeah.
But you can't do that, right? You don't have that option.
No, because I'm an equity investor, number one. What value am I adding by buying bonds here, especially given the fact that, I mean, we know the bears think that rates are going to zero. I just simply cannot believe that. If rates go to zero, we're all in trouble. And I think that is way too much of a binary effect. And we are longer-term investors, and we think the U.S. economy is in good shape. And we think the U.S. market will continue to be a home for assets.
Bruce, what's your feeling on the market? Are you as optimistic as Brian?
Well, for the second part of the year, we are. I think what happened in the first part, we had a strong rally in the stock market that likely overshot the fundamentals. And now we have the same thing going on in the bond market. We don't think the economy is as weak as the 2% 10-year Treasury note would suggest. But with the trade talks continuing, it's really a question of a confidence. And as long as consumer confidence remains high like it is right now, I think there's no problem. The economy will continue to grow, maybe around 2%, maybe 2.25% for the rest of the year. But the market is likely to continue to experience large bouts of volatility until these trade talks are resolved. And that kind of fits with our outlook that we had in the beginning of the year, that the market would do well in the first quarter, have a pullback in the second quarter, a testing phase, if you will. And then by the time we got to the fourth quarter, I think the markets would begin to start back up, and that rally could continue into the middle of 2020.
There's a new headwind out there, Brian, and that is the market leaders are all being investigated by the government around antitrust and anti-competitive behavior. I mean, does that represent a challenge for the overall market, because they have taken us up through the last few years?
Well,
I think it's
no
challenged. Oh, sorry, Bruce. I think there's a challenge, quite frankly, Sarah, to those people that are short-sighted, that are crowded into these stocks. Because if you take a look at the stock market performance since the day after Christmas into mid-February, early March, the market was broadening out. And then once the momentum trade turned on again, ran right back into the MFAGs. Now, I think Facebook has some other issues with respect to fundamentals. I think Google and all of this is going, Google, Netflix, Apple, more noise right now. And so we still think that those names from a longer-term perspective are okay. It's going to afford
You buy them?
Yes, I'll be buying these on the dips because you're talking about Apple with a cash balance sheet. I don't care where the cash is, that has more cash on its balance sheet than certain states in our country. So you know what? Follow the cash, follow the consistent earnings, and this is going to provide an opportunity longer term.
Bruce, what were you going to say on the tech stocks?
Well, I was going to say that this adds another level of uncertainty, the government attacking some of these tech companies. But if you look at the market this year, and the areas where we've been recommending have been defensive sectors like utilities, consumer staples, REITs, communication services. They're having a great year and continue to buck this trend. So there's a lot of places in the market where you can make some money.
Bruce, just want to end on the Fed. Got some Powell headlines. I don't think there was anything really to move the market. The Fed's going to respond as the economic conditions warrant. The fact that the bond market expects a cut this year and the Federal Reserve is not singing that tune yet, does that represent a headwind in your view?
I think it represents some risk. Certainly what's being factored into the market now is at least one rate cut and maybe two. And Powell is sitting on his hands right now and suggesting that maybe no rate cuts in 2019. So I think that represents a risk in the market, expectations of a rate cut too high.